back to the Mike Rosehart Show. We're live here again, like we are every Wednesday. And today was a very interesting day. I had some fun investing in the stock market today, and it's been close to the first of the month. So I've dealt with the brunt of all of the challenges with owning rental properties. Around the first of the month, it's the most stressful time for rent collection. Typically, when tenants are paying rent, that's also when they're like, oh, I have all these problems and therefore don't want to pay rent. So typically the first of the month is the worst time to be a landlord. And that cycle of the, towards the end of the month, start of the month, when everything's chaotic. In the student world, a few times a year, it's really bad. But depends on what kind of properties you have and that sort of thing, the types of tenants that you have. But I have come across a revelation, and I've changed my entire investment philosophy. If you've been watching the show over the last several months, you've probably noticed the change in my mindset and the shift towards a differing investment philosophy, one that focuses my internal goals on maximizing time efficiency and reducing risk wherever possible, maximizing returns at really reduced risks. And I'm evaluating all of the assets in my portfolio, real estate included, my stock portfolio as well, and the other asset classes that I hold. And I'm looking to de-risk where possible and also optimize my life. So one of the things I'm going to mention tonight for people who are keen or eager, I have lots of properties that I'm going to be disposing of. They're almost all in London, Ontario. I have a few in Sarnia, but they're primarily in London, Ontario. And apologies for my kids outside the door here. I don't have a better office to be in since my little crypto operation is in my other office. But I'm talking today about some of the properties, and I can drop details if people are interested in some of the properties and kind of share what I've got. I've got a duplex at Oxford and Western Road, which is 3-bedroom upper, 3-bedroom back unit, 2 driveways in like the 599 range, probably somewhere around there. Legal duplex. You could make it a 3+4 bed probably. Anyhow, that's a deal that'll be hitting it. I got some triplexes near Western. I got a triplex near Fanshawe. I got another duplex triplex near Western. A couple other properties that'll be hitting the market, and some things I was throwing out there for people who maybe can't qualify for A-lender mortgages. I've got 2% mortgages on these now. I haven't refinanced them since last year, and so you guys know how the market's been in the last year. There's a bit of equity left in these properties, but as of last year, they were refinanced. So if someone wanted to JV and I continue to hold the mortgage and they do all the work and they get 100% of the cash flow, whatever, it's their property, I'm effectively just holding title of the mortgage. I'm open to that. So for my subscribers who have a boatload of cash, if you got a lot of cash and you can't qualify for a mortgage and you want to buy out the gigantic amounts of equity that I have in my properties, like in some cases I've got $250,000 in equity in a single property. But if you want to buy that over and put 33% down and take over my 2% mortgage, cool. There might be something there. If you're looking to buy properties and you're still in the phase of your investing journey where you're looking for stuff that is cash flow positive but requires time, like you're gonna have to place students, or you're gonna have to grind it in the trenches doing the management yourself. And if you value your time at less than $100 an hour, which that's 90% of the population, 95, I think it's like 98% of the population, a very small percentage of the population has time worth more than $100 an hour, for real, like on average. I am fortunate enough that my time's worth $500 to $1,000 an hour in most cases, most of the things that I apply myself to. Real estate acquisition is worth it for me. Flipping is probably something I'll still do. The occasional undermarket buy I'll do, but the whole piece doesn't make sense for me. One, I'm a public profile. This is where I'm coming from. So one, I'm a public profile. So even if I have a property manager, tenants find my number online, they find me on social medias, and they reach out to me and they pester me. So if my property manager doesn't do a good job, it reflects on me personally. That's an emotional piece that I don't like, mostly because there are no good property managers. I've never met a property manager who can do things as lean as I can. So getting in cheap trades at $25 an hour to fix things in a efficient way, putting in great tenants, caring about the building in the same way that I could. I can't care for my properties. I don't want to care for my properties anymore. Therefore, I shouldn't have properties. That's sort of the conclusion that I've reached, right? 2 is that just finding good management is like nearly impossible. 3 is return on equity. My return on equity is not fantastic. I've seen 30, 40% appreciation in the last year in this market, right? In some pockets of London, it's 45, 50% appreciation. Now, part of that's the money printer going brrr, right? So some of that's out of our control. Some of it is value add. I've already made the property, in my opinion, as good as it's going to be. And so there's some opportunities maybe to fix it up a little bit from, tenant damage. But I think, I'm looking at my portfolio and I'm like, the return on equity, like a 10% return isn't going to move the needle for me. I'm not excited about that. Even if you gave me a 15% or a 20% return to manage real estate, I'm not interested in that. What ends up happening is I'm finding that it's just not worth my aggravation, my stress. And I'm at a place where I have that FU money multiple times over and I'm just done. I it just doesn't make sense for me to hold real estate. So as the real estate investing guy, I will continue to acquire real estate because I have, to quote Liam Neeson in Taken, I have a very, very, very valuable set of skills that I've acquired over a lifetime or a career of investing. And those skills make me very deadly when it comes to acquiring. And those connections that I have make me very valuable in the acquisition space and turning places around. But just do not have the desire to buy and hold. And so, yeah, I will be disposing of over the next 3 to 24 months, 18 properties. I've decided, I've got a plan, I've laid it out. From a tax perspective, I've kind of accepted the fact that, oh, William, I couldn't help but see the word AMC there, so now I'm going to read it because today was all about AMC. Anyone watching AMC pop? Mike, curious on your voice on AMC stock, TY. Okay, so before I share my opinion, I will say that I am currently short AMC. I acquired a short position on AMC today at the peak, nearly $70 a share. I sold calls, several of them, for an August expiration, and it was paying, and some in July as well, and actually some in June. I'm probably going to roll it all to August because I don't know how long the market can stay irrational. I just don't know when the squeeze is going to end, right? But essentially, I can share with what I've uncovered so far. So yeah, the full disclosure is, again, I am short, so I'm betting money AMC is overvalued. I've put my own money there. I stand to make, I don't know, 50 grand, I think, just on the contracts that I wrote today. If by August the share price is less than $60 a share. And again, I'm going to talk about where we're coming from here. Earnings per share on AMC, negative $16. So every share you buy, you're accepting negative $16 that you may have to put up to carry this company as a shareholder. You can be liable for their debts, right? So hopefully they'll use this capital raise to pay off debt. That's what they're saying, right? But then what? At the current valuation, again, AMC has now popped off to a higher market cap than GameStop. It's an insane meme stock that makes no sense fundamentally. I understand where it's coming from, and I understand why people are jumping on board, and I get that piece. What I don't get is what happens when you're left holding the bag of turd. AMC shares are intrinsically worth a few dollars a share. If AMC filled all of their theaters, pretend COVID's gone tomorrow, pretend that the world's back to normal, and they filled all of their theaters with people. By the way, it's not going to go away. There'll continue to be variants, is my prediction. But beyond that, we've got to deal with the fact that there was a nice post that I shared today on my Instagram. If you follow me at Mike Rosehart, you'll see that I shared on there. If, quick back of the envelope calculation, if they filled all of the theaters 6 days a week, and the average concession spend was $100 a customer, they still, for 10 years, the next 10 years, they still wouldn't justify the current valuation. So there is no argument for valuation here. You're holding on to dog shit. Now, maybe that shit you could sell to someone else for more, and that's literally the hope. That's why everyone is investing their hard-earned stimulus checks into AMC and other meme stocks. So that's what's going on in the world. Now, I'm all for the small guy taking on the big guy. I like that small guys on Reddit have come together in hordes of millions and decided, hey, we're gonna teach these Wall Street shorting suits a lesson. And when they need to cover their shorts, there's gonna be no shares for them, or they're gonna pay through the nose for those shares to cover their short position. And even though the analysis that they did is probably right, and they were probably justified in shorting the stock, we're going to teach those suits a lesson. We're going to take what's ours and make a big profit. And it's going to be the Wall Street guys that buy our shares and give us huge lifts. That's basically the premise behind the 5 big meme stocks. Bed Bath & Beyond up 42% today, 45% today. GME, GameStop popping off the, not as much as AMC or some of the other meme stocks, popping off today as well. And of course, AMC with over 100% up day today alone. So at the peak of today, I was like, I've been watching AMC, and I was like, maybe I should get in a little bit. If I'm feeling like gambling, I might gamble with the masses. I was watching a lot of social media attention on AMC, and I'm like, wow, there's a big pump and dump going on here. And interestingly, if an institution does it, if the company themselves does it, or anyone who has a license or a corporation does it, it's considered a pump and dump scheme. You go to jail. But if you're just like a random person and you just say, hey, like, this is what I think, and like you can convince millions of other people to do it too, and then you make a huge profit, that's not illegal, I don't think, currently, how it's written. So my understanding is the regulatory bodies can't touch individuals for coming together and basically colluding, which it's collusion, right? It's okay when small individuals do it, but not when a bunch of rich individuals do it. I don't know. Anyway, it's been going on since the beginning of time. We've had collusion, but it's interesting to see the small guys coming together on Reddit. And to be honest, probably there's suits and funds that are behind the Reddit pumping too, and probably enjoying some of the pump and dump behind a wall or a layer to protect themselves. I'm sure that there's a lot of that going on right now. There are smart individuals who can get on the bandwagon. And then once you see this pop that they're able to create, then of course all of the gamblers jump in, and the volatility goes crazy. And we were seeing IV on some of the options contracts for AMC today at 650% at one point, 700%. So just insane volatility measures on these stocks, and or on these options contracts rather, and the stock price too. Just wild that it was halted 4 times today, just for the exchanges to catch up. Just been a wild ride today with some of the meme stocks. I don't bet a large percentage of my portfolio, a very small percentage of my portfolio. I'm dabbling. I don't want to buy any shares of AMC other than like if it was still at $10 a share or something, I might have bought a little bit, been like, I'm overpaying a little bit. But I believe that the masses are going to get in here and I can dump it to someone else later for more greater fool, right? Ride the wave. I get that. I can see that line of argument. Even myself, I could be susceptible to that. What I know confidently right now is that years from now, when you're holding a bag of dog turd, which is AMC shares, or any of the meme stocks really for that matter, they're gonna be worth significantly less. And so I am confident enough to put my money where my mouth is, and I am actively selling calls naked at a future point. And I will roll them as long as I have to until I am right. Because eventually I will be right. I will pull a Michael Burry 2008 real estate. It feels just like that. Like the intrinsic value of AMC is not there. Eventually, the shorts will be there'll be short squeezes. Everyone will be, they'll get the shares they need. Someone will sell. Like in a recession, people go into hard times, whatever. Someone's going to sell their shares to them. It might be at a premium. That's the whole idea, right, behind these meme stocks, is that you want to make the suits really pay for the shares they need to cover their shorts. I'm of the belief that eventually people will realize what they have and they will try to sell it off. They will realize that they have nothing. And I think people sort of understand that now. Like, okay, I realize that I'm holding a brick and mortar movie theater business that is not profitable, closing stores, and has no chance of ever being worth the current valuation without a major pivot in their current strategy. And like, we're talking like another company, a total different company, like complete speculation here, right? So I am not a speculator. I'll probably dump on the next down day. I'll probably clear off all my positions. I just think it's overvalued. At some point, I'll be right. There will be a volatile down day, and I will cash out, and I will make money. Is this the top? Who knows? There's just starting to get a lot of media attention around this, and the problem with 100% jump day is that it gets a lot of media attention, and then all of the gamblers jump in and like get the FOMO, right? They just missed out on 100% gain. Maybe they can make 100,000. They can take their 100,000, turn it into 200,000, right? Or maybe you have $1,000 stimulus check and you turn it into $2,000, right? And they're like, I'm gonna put it all in AMC and see what happens, right? That sort of mentality is gambling. It's gambling. I like it better than gambling in some senses because at least you're holding something. Like the intrinsic value of AMC is probably a few bucks a share. Like they got a lot of really great brand recognition. They do have a lot of movie theater chains. There probably is, $5-10. I like the comment I just saw jump up here. Mike can stay solvent. We can't because we're broke. So Ram, to your point, if you're selling calls, you could just continue to roll further out. You can roll the contract and keep getting credits. because there's so much volatility, and there will continue to be volatility, so long as the fundamental analysis has no correlation or causation at all to current market cap and price per share, right? So as long as those two things are disconnected, intrinsic value will be high. It's very likely that it will continue to pay well. And so as time goes by, you should just make money literally from the expiration of the contracts, right? Even if the shares stay the same, right? But further, you can continue to roll those contracts. You don't need really a ton of money. Like, it's not like we're shorting, you continue to roll those contracts. If they're a month out from expiring, you're like, I don't know if I'm gonna make anything, roll it again. You can keep rolling it for a year if you want to. You keep getting credits to roll it, continuing to insure it for a future time. And eventually, the world will move on to a new meme stock or something different. Attention spans are short, and the real inherent, attention or eyeballs that are on, like the value of the eyeball. There is value, by the way, in eyeballs. Like, GameStop could actually take all of the attention and the capital that it has right now and pivot into selling games as NFTs. And I think that'd be a huge boon for the company overall. They could attract a lot of really great talent, as an example. There's just a lot of things going for eyeballs. Like, having attention is power. And so there is something from that. But the intrinsic value, again, of GameStop is also not the current price. Maybe someday they'll be able to take the attention and the capital they've been able to garner from these, Reddit stuff, and maybe they can turn that into something in 5 or 10 years. I don't want to pay for potential future growth. Could happen. Who knows? Like, I myself am not a penny stock investor. I like to invest in blue chip stuff. But I am confident that eventually shit is going to catch up with AMC, because the earnings, the revenue, the assets, they aren't there to justify the current price. It just doesn't make sense, right? Something will change, something will happen, and attention will shift, and the price will correct back down to fundamentals. It has to. That's just how it works. So eventually I'll be right. Like, you can mark this down your calendar, and we can check back in a couple of years, and AMC will not have the same price it does now. I guarantee it'll be lower than it is now at some point. There'll be a down day where I'm right. Like, I don't know if it's tomorrow, probably not. Looks like it's going to be another heat day tomorrow. But in the next few weeks, there'll be a down day, a big down day, and on that volatility, I'll catch up and make some money. On the next crazy up day, you could gamble on that too. I'm not really a gambler. I put such a small percentage of my portfolio into this. I'm not betting the farm, and I've got stop gains and stop losses set, so I'm not, I'll walk away and it's okay. I want to be part of it. I just want to have a little fun with it. I don't think you should put your whole net worth in it. People have like 20 grand, that's all they have. And they're like, I put it all in AMC and GameStop. I'm like, what are you doing all in Tesla, GameStop, and AMC? Like, talk about diversity. This can be like 1% of your portfolio, maybe. Have a little fun with it. But it's, I don't know. People are crazy. Let's go back to the comments here, and I'll let you guys lead the conversation. Hey, Will, good to see you on. William, good to see you on too. Linda says, you're getting older and you're getting wiser. True, I am getting older. Wiser? There's a lot that I don't know. I don't know a lot of what I don't know. I've been battling with that today. I made some terrible decisions from a tax planning perspective. And I'm like, geez, there's a lot of things I just didn't know that I didn't know. And so I'm always learning, and I'm always trying to, change my perspective and try to find new information that allows me to be a better me, a better version of myself, and a better investor. And part of that means, I try to ignore the noise as much as possible. I try to say, like, I look at AMC and I'm like, I don't know where the price is going to be. I don't have a crystal ball. But like, as an example, I look at the intrinsic value there, and I'm like, wow, there's a huge disconnect here. Enough of a disconnect that I would bet that at least for a day in the next month, I'm going to be right. It's going to be a big down day, and I'm going to make some money. The volatility is insane. Probably you could just trade the volatility alone and just spread trade and make a ton of money too. I haven't looked into that a ton, but I'm sure that I'll check into that tomorrow. There probably is huge profitability doing that too. But for the most part, my investing strategy has been buy puts on really down days on beat up stocks and buy it way out of the money. Like Twitter, when it was having a really bad day, I might sell some puts on that 30% below the current price. So I might have to take the shares at 30% below the current price. There's a 99% probability when I wrote that contract that I will never be assigned shares. I will get money for nothing. That's what I'm looking to do, is stay way out of the money, super safe. Like I was selling calls, by the way, on AMC at the highest possible price that was literally that was the highest price of option in the market that there was a market for. If I could go higher, I would. You know what I mean? Like I like to take very little risk, as little risk as I can for the best reward that I can get, right? And the majority of my portfolio is taking very calculated, small wins over a consistent basis to make, you know, a good return. That's sort of been my strategy. And then on the dividend side, I built a portfolio there that I think is resilient and tax efficient. I don't do all options trading. I have different portfolios that I kind of play in, and that's sort of my perspective on that. Hey, Mike, have you considered offering an annual payment discount to tenants? Sure, Jay. Like, to be honest, I have no interest in doing property management at all. Like, I get no joy from talking to a tenant, repairing a property, anything to do with my properties. It feels like I'm doing it for nothing, because the return you get for your time is almost nothing. It's like 30, 40, 50 bucks an hour, 100 bucks an hour, whatever. It's rounding errors to me. Like, it doesn't even matter. So I look at the grand scheme of things, and the only reason I'm holding my portfolio is appreciation. That's it. FOMO. I'm afraid that it's going to appreciate another 40%. And then I'll be left behind because the money printer's going brrr, and I'm worried that I'm going to get left behind if I don't have a lot of leverage and a lot of assets. And so that was a big piece of why I continue to hold real estate. I can replicate that same leverage and appreciation by having no tenants. There are ways to do that with REITs, as an example, or there's lots of other ways you can do it too, where you can ride that appreciation levered using Interactive Brokers, you know, prime minus 1% leverage. Like, I can go borrow at 1% and do the same thing. Whereas in real estate, I'm borrowing at 2.5%, and I can get better debt, zero stress, the same return. Why am I holding real estate? At my level, again, I have a lot of assets, and so even if I got, you know, a 12% return instead of, let's say if I really applied myself to my real estate portfolio and I was efficient, you know what I mean, I was getting tenants at top dollar, and I was making sure there was no vacancy, and I was fighting hard to make sure maintenance expenses stayed low, and I was watching utilities, putting locks on the thermostats, I was maintaining everything perfectly, and I was running things like a nice clean ship, and I had, you know, everything going really well, I might maybe squeak out a 20% return on my portfolio. Maybe. Because, you know, again, return on equity, as it appreciates, I have more equity in the property, which means a lesser return, right? It gets harder and harder to get that 20% return. Next year is even harder, unless I go through the work of refinancing all the properties, which again is like a job, something I'm not interested in. But I would much rather a 12% no work versus a 20% with a lot of stress and a lot of work. So that's a personal choice on me. I'm okay with less. In fact, I believe I could apply myself in, you know, as with an active trading business, or in building like a cryptocurrency business, or other businesses that I would enjoy doing. Like, I don't enjoy talking to tenants. I don't enjoy, you know, moms of students calling me. I don't enjoy fighting with tenants. And a big piece of it is the entitled mentality. And not all tenants. There are a lot of great tenants too, but a lot of tenants are entitled. They're like, hey, I paid you rent, so I want my curtains leveled. I want my grass dandelions pulled out. The requests you get are just insane. And like, people are just so irrational. And the climate here in Ontario, I don't feel is conducive for landlords. The rules are not in our favor. I don't want to play in the sandbox anymore. I get that the returns are good. I get a lot of people are investing in real estate. It's just not for me in London, Ontario. I will still flip. I'd probably still do Airbnb, because again, you have a lot of control over vacating a unit immediately. If someone doesn't like it, they can cancel the reservation, get a full refund. Cool, win-win. We're all good. If a tenant doesn't like something, you're stuck with that tenant. You have no choice. They can trash your property, and there's nothing you can do. It's really not a great environment, I think, compared to the other options that I see out there for my capital. And I'm okay getting a lower return for no work. And why don't I do Airbnb? Someone just asked. Because Airbnb is a lot of work and a lot of risk. There's a greater risk running an Airbnb business. Look during COVID, when there was pure vacancy. You were throwing thousands in your property. Or look when a tenant, I've had an Airbnb tenant or Airbnb guest, they're not legally tenants, guests stay and trash the furniture and left a bogus card. You've seen in my stories, if you followed me on Instagram, Mike Rosehart, you saw stories about that last year, where we had some really terrible Airbnb guest quality during COVID. There were no travelers. And so you were left at the bottom of the barrel. People who are kicked out of their houses had nowhere to live, make fake profiles in Airbnb or get their friends to make profiles, and they need somewhere to stay, so they book a house. And because Airbnb was the demand was so low and the supply was so high, you could rent a house on Airbnb furnished cheaper than you could actually rent a house. There were some really cool pricing deals. And so people were taking advantage of it and just living in Airbnbs. And it was the scum of the earth tenants, the bottom quarter that had like multiple pets and just so much crap, right? And so I've been through that game. I've done that, a lot of that. I've had managers. I find vacancy rates are very high. I find the damages and the turnover can be very high with Airbnb. There are pros and cons. Like if you're on it and you're managing it like white on rice, and you got a good manager that's just like on that and just watching everything and running it really well and has good systems in place, it can be profitable. For sure it can, no doubt. I felt like I was managing the manager and I don't want to put any time. I don't want a real estate business anymore. There was a time where I had a real estate business. Like there's no doubt about it. Owning real estate is a business. Every property you have is a business. The problem is every tenant expects that you're their only client and you can't fire the client. So it's a business that I don't want to be in the same way that I am now. I don't want to have tenants and I don't want to have responsibility to my tenants or my properties. Properties require a lot of work. So yeah, I think that, super chat. Randy Jass says, hey Mike, what's the rundown on how you would invest an income of $20,000 a month? That's after tax amount in Canada. Let's just stop for a minute and enjoy that. $20,000 a month after tax. Now that's probably like a $40,000 pre-tax income. So that's fantastic. That's a good amount of money. How do I, again, I think one of the best ways is to look internally and derive a value system of things that are important to you, right? A big piece of, and by the way, super chats always get priority. That's why I'm giving it priority right now. If you super chat, it supports the channel. Thank you. I've turned ads off, if you've noticed. YouTube still puts them in somehow, sometimes, but I've turned them off completely. If you've noticed in the playbacks, if you're watching the playback right now, you're one of the 83 people watching right now, or you're one of the 2,000 people that will probably watch this in the next week, you're welcome. There are no ads. I took them off. I don't care. My YouTube channel makes 0 now on videos that I post. So this is the only way I make any money. So cool. Making money means it's like eyeballs and attention, right? The two things that matter are someone giving you their attention, and the next most important thing is someone giving you their money. I think attention is more valuable than money, and so when you give me your eyeballs, it's a big thank you. It means you actually care about what I have to share. But I'll run through some examples of what you could do. So remember, $20,000 a month is a great amount of money, and depends on how much you need to live, but if you can take that $20,000 and you can reinvest that into whatever business is making you the $20,000 a month, that's usually the first place I would look to spend at least half of that. Or save, I say spend, but invest. Save and then invest at least half of that back into that business probably. If you're making that kind of money, you're probably in a business that if you invested more money in marketing or in some new equipment or in some expansion, you could probably make multiple folds of return. I find most entrepreneurs I talk to, and I was just assuming you're an entrepreneur, I have no idea, no context there, and it's hard for me to give good opinions without that context, but probably a good portion of it should be back into the business. And I think that another portion should go into like an FU safe money fund. Like if the business dies tomorrow and like whatever your business is in, it's dead, put it somewhere safe where it can compound and grow. For me, safe asset classes are like land, real estate is a safe one. So if you could potentially buy REITs, go open an Interactive Brokers account and go buy into some if you like Canadian residential student rentals. There's probably a REIT that just does residential. You can stay away from commercial if you don't like commercial. I know commercial's getting hammered in COVID. There's a drop in demand. A lot of the commercial supply is being converted to residential because tax rates are better and interest rates are better on loans. And again, it's just a higher demand because immigration to developed nations is on an all-time high. And the plan for the future is an all-time high. So residential real estate is still on a big growth trajectory. I wouldn't be surprised to see another 20% appreciation in real estate. It could happen in the next year, very likely. So anyway, I think that's a nice safe piece. I like cryptocurrency, to be honest with you, as a nice, like, take 10% of that 20 grand a month, take 2 grand a month and buy the dips. Go buy Ethereum and Bitcoin on the dips. I think long term, I could see a year from now, Ethereum being $10,000 a token. I could see Bitcoin being 50 to 100,000, no problem, like almost guaranteed. So it's a safe place to put it, and then stake it, which means basically lending out that. It's like buying gold, but then you can lend it out at a percent a month. There are exchanges you can upload your coins to where you continue to hold them. Any appreciation that happens is yours, but you're staking them to provide liquidity. And in many cases, it's like basically think of it like you're lending out. You're lending out that instead of lending in fiat, you're lending in ETH. Staking for ETH is coming with 2.0, and you can already convert to akin to like tokens that mirror ETH and then lend with that. And I think that a big piece of that strategy is that you can hold, enjoy all that appreciation. It's there, it's your safe money, and then you can get, there you go. So BlockFi as an example. There's a million other ones you can convert to that all do it too. So you got to evaluate the platform, make sure it's relatively safe, the token that you're getting into. But I would take probably 10% and put it into ETF, like a ETH or Bitcoin. Maybe you could pick some like Cardano, or like there's lots of other cryptocurrencies you can look at. I like Kudos and Ultra if you're gonna pick some like really small altcoins. They're doing some cool things. Look at the projects that they're doing. Research for yourself. But I think you'd probably be safe to put 10% away into that. You put $2,000 a month into that. I think 5 years from now you'll have 6 figures sitting in that account. If you just do that, for the next couple of years, put the money away, you'll have a good 6-figure healthy crypto portfolio, which I think long term is going to do really well. So that's something I would throw 10% into. I would build for myself. I'd be able to try to replicate that income and do it in a safe way. So the next bit of money I'd probably toss into Interactive Brokers account, and I would get them. You open basically a line of credit, right? You don't have to do anything. It's automatically opened as soon as you buy the shares. And the biggest thing that you want to look at is taking that capital and saying to yourself, what happens if I lose this $20,000 a month? How do I replace this? That's been always an investment, mindset that I've had. And so I think the dividend portfolio is the way to go. Build a dividend portfolio inside of Interactive Brokers. You could do something really safe, buy 100 different positions, or buy ETFs. It's a nice, easy one too. If you don't understand the stock market, you don't want to spend the time, just go ahead and buy a bunch of, exposure to Brazil, Russia, India, China, like BRIC. Buy a little bit of the world ETF stuff, buy a little bit of high growth, buy a little bit of everything. And the nice thing about Interactive Brokers is you can borrow against those stocks 70% loan to value, right? Another thing is that I really like is you can go 3.34 to 1 inside of Interactive Brokers at a 1% cost of debt once you've got over $1 million. But even if you have like $10,000 in the account, they still let you borrow, I think, at like 1.6% interest, which is again prime minus like 0.8% or 0.9% or something. So still really, really attractive borrowing rates. And then you can basically, if you had $100,000 in Interactive Brokers, you can buy $300,000 in shares. Now that's maximizing your leverage. You might not want to go that far. Maybe you say, I'll go 2 to 1 and leave a bit of margin there in case there's a recession or a dip, right? Save the leverage to buy the dips. And when you see dips in the market, big corrections, big little crashes you'll see, that's the time to really buy in with a dollar cost averaging approach. And that's a great way, I think, to kind of build diversity. But it depends. I think for each person it's different. Like you might have, again, going back to the internal goals, if you have time on your hands, you could build your own crypto mining rig in your basement. And that gives you at least 100% return on your money every year. You can literally buy the graphics cards that you can sell off later for what you bought them for after a year of mining on them if you take good care of them. Even 2 years, you probably sell them for what you bought them for. And you can basically mine crypto. ETH right now, I have a mining operation. You can mine on a $10,000 investment into an equipment rig. You can mine $12,000 a year, and if the price appreciates, you might mine 20 or 30,000 in a year. And so the return can be very, very attractive as like a little side hobby business. There's lots of other side hobby businesses you could do too. Like it really depends on what your goals are. Right? I don't have a lot of context there, but yeah, I think at the end of the day, it comes down to trying to focus on what happens if that $20,000 a month dries up. Do you have a plan there to protect yourself? And that's what it's all about, is managing risk as low as you possibly can while trying to get a great return. And I think there are some businesses you can invest in, some great places you can put it in where you can get a great return. Things I'd stay away from, I hate bonds. Stay away from bonds entirely. In an inflationary environment that we're in right now, bonds suck. You lend someone $100, they'll lend it back to you in a year, it's worth less. And bonds don't pay enough for the risk. Like you're getting 1, 2, 3, 4, 5% return, maybe. Treasury bills, all that crap, stay away from that stuff. All government, treasury bills and all that kind of stuff, stay away from that. That's a terrible place to put your money. Don't have any bonds in your portfolio. I know people argue for a 90-10 split, 10% bonds, 90% equities in a stock portfolio. I say 0% bonds. Instead, if you want a lending component, lend using crypto or lend using real estate. You can basically sub in real estate, really stable stuff that gets similar cash flow as bonds. And honestly, you could find ways to beat the liquidity issues with real estate, right? There are ways to insure against that. So I think that's something to avoid. Another trap to avoid is going to your bank and opening mutual funds. Mutual funds suck. They have a 2.5% in Canada, a 2.5% MER drag. MER stands for management expense ratio. MERs are the death of your portfolio. The advisor, the bank, all the people involved in selling those mutual funds, they make 2.5% every year on your portfolio, whether it's up or it's down. You're down 10%, you're actually down 12.5% because they're taking 2.5% for the year. They're taking half that, taking 2.5, right? The average return on the portfolios they build using bonds, because again, most of their safe stuff that the bank sells bakes in 30-40% bonds, right? And a lot of the conservative portfolios, that they'll sit you down at the bank and be like, here's a conservative portfolio, here's like a moderately conservative portfolio, here's like a really safe portfolio, here's the aggressive, less risky portfolio, and the aggressive portfolio is like 90% equities, right? That bakes in a lot of fees, and you pay a lot to your advisor, which could add value. Again, there are advisors who do bring a lot of value to the table, but at the end of the day, I think that most of the time you're better served self-managing. Most of the time, that 2.5% fee, if you add up that fee you're paying to your advisor, it's paid out to your advisor, paid out to the bank, etc., the managers of the funds, you could just buy an ETF, exchange traded fund, which does the exact same thing as a mutual fund. The exact same positions in it. It just is robotically managed and has a very low fee base, and you buy it yourself as opposed to buying it through the bank. You open an Interactive Brokers directed account, and you can just go buy the tickers, go look up, type in like lazy couch, Canadian couch potato, and you find a bunch of portfolios there, and like the Swanson Yale portfolio. There's a whole bunch of them out there you can just copy. Like literally go out and they'll give you a list of like the 10 ETFs to buy. You buy them. Someone just commented about bonds. Like I can do lending against real estate, secured against Canadian real estate, 70% loan to value, which means the real estate market has to crash 31% before I lose my first dollar. And if it appreciates, as the real estate appreciates, or as they spend money improving the property, et cetera, and so forth, my risk goes even further down. So I would say it's near a risk-free return. I think a 30% correction in real estate, because the government would step in and stop that. We've never seen a correction like that in Canada, again, because we have recourse mortgages, where they don't in the States. So it can't happen. They have non-recourse mortgages in the US. You can walk away and throw the keys at the bank. In Canada, you can't. You can't walk away from your mortgage. They will literally bleed you dry. There's no way to walk away and throw the keys at the bank. So Canadian real estate, if you're lending against good quality Canadian real estate at 70% loan to value, I argue that is a risk-free investment, near risk-free investment, especially if you're lending on a solid quality property, the good appraisal, et cetera, so forth. That's a near risk-free. I think the government is more likely to default on their treasury bills than you are to not get your money back out of that property, out of that mortgage. So I would rather do that. And I know about opportunities where I can lend first mortgages at 10%. So I get a 10% risk-free return, or I could do a risk-free bond at 1%. Trash. This is trash. This is great. So I unsecured lending is trash. Like there's a bit of risk there if you're lending to the wrong people. So you gotta be careful about how you structure things. But if you do it structured as debt, and you do private lending, and you do it, you reach out to some mortgage brokers and say, hey, I'm looking to fund a flipper. I'm looking to fund someone who has a $1 million house in Toronto, and they don't have the proper income to service it, and they just want to put a $600,000 mortgage down. And you're fine, because they have a $1 million house in Toronto. Like, you're good. Even if they default, you take their house, you sell it on MLS, you recoup yourself, whatever's left over, you make it in a bunch of fees. If they default, you actually make a greater return. You can make 20-30% return on a default, because all the fees you bake into your mortgage. So a default actually can be very, very attractive. Honestly, like that's what you want, really, is a default, because that's where you get all the fees. You get to start taking into their equity. I know, baby, almost her bedtime. I gotta go, guys, pretty soon. I got about 5 minutes left here. Let's see what I can get done. I'll thank you for the super chat, Ram. I appreciate it. Great content. Thank you. Okay. Next up, we've got. Can you talk about the properties that you're selling? Do they cash flow at current price? Do you have a good property management company recommendation? So Ruben, I'll kind of walk through that at a high level. I'll walk through like 3 or 4 properties right now that I'm going to be selling pretty soon. 37 St. Andrew Street duplex, check it out. 599 price range. It's at Oxford and Western, great location. 2 driveways. It's got a back unit with sort of a bedroom above grade and then 3 below, and then it's got a main floor unit with 3 bedrooms. And then I've got 161 Fellner, which is a triplex with solar panels on the roof. It's generating almost $70,000 a year annual gross rents. I would sell it for around 700, so around 10 times on that one. It's in East, sort of near Fanshawe, on a decent quiet street, lots of parking, 3-car wide. Hey girls, I can hear you, but Daddy's on his stream, okay? I'll be out soon. Be out soon. Dad life. I gotta tuck the kids into bed here pretty soon. 86 Wilson is another one. It's a triplex. I have some off-market opportunities too of investor friends that I know. So if you want to reach out, I'm trying to help them as well. Got a few other properties that I can send out to people as well. That if you message me, I can send you a list of all of them. 32 Wistow Street is another one. It's a sort of duplex. It'd be in the 400 something range near Fanshawe. It's a semi-attached, but it's got like 6 bedrooms. There's just a ton of properties that, like, most of my student rentals are the most annoying, but I have a few triplexes and duplexes that I would sell off too, if given the opportunity. I would look at tons of opportunities to, partner with people or whatever. I don't want to do any management at all. I don't want to be part of the operating, because I know if I'm part of the operating, I'll be worried about keeping costs managed. And if I'm worried about that, that takes up mental space, takes up stress. I don't want to be involved in the operating at all. Whether it goes well or doesn't go well, tons of cash flow for you. Yes, the short answer is yes. All these properties cash flow. Do they cash flow well enough to justify the work? I don't think any real estate property in Ontario cash flows well enough for me to want to hold it. Literally, you could bring me a property in London, Ontario at 2% rule. You bring me a property that brings in 200 grand a year in rent for $500,000. I would buy it in a heartbeat, but I would sell it. I would go sell it off after for $2 million because I wouldn't want to hold it. Just at market value, there is an investor willing to pay more than I want to keep the property. They want to pay more than it's worth to me to keep. The stress and aggravation isn't worth it for me. That's why I want to part with my portfolio. So if you're super serious and you have a big pile of cash and you want to buy some properties, reach out. If you're not serious and you don't want to, don't waste my time. Like, don't go on Instagram and message me, can I have details on your properties and net operating income statement and blah, blah, blah stuff. If you don't have a couple $100,000, like, I don't want to waste time. I consider my time valuable. I'm a realtor and I don't even list my own properties. I get another realtor to do it because it's too much work to field the inquiries. I consider that a low value use of my time. And so, yeah, that's that on the real estate front. I just thought I'd throw that out there because there are people who are still in the acquisition phase of their journey and they want to buy a whole package of properties. Reach out to me. I got a package of properties in London. I will price them at between 5 and 10% under market value. So free value for someone who wants it. At the portfolio of what it's worth right now on the MLS. I got a pretty good idea looking at the comparables, what my property's worth, knowing the income approach, what my properties are worth and their potential. I'm the king of maximizing potential. I just don't want to do the work anymore. I would fix some of them up a little bit if necessary and I had to list them, but if I can sell them privately and not do any of that work, that's a win. My favorite is when an advisor says volatility equals risk and not the permanent loss of capital. So, volatility can also mean an opportunity to make a lot of money too, right? With volatility, you could set a stop, like you can do spread trades using options contracts where your max gain and max loss are capped and you can't lose money. As long as there's a lot of volatility, you get a lot of premium and you can just stay within a band, and as long as it stays within the band, you win big. If it goes out of the band and it drops big time, okay, your loss is set. You get like whatever the contract value is, you lose that, whatever. Not a big deal because you're only betting a very small percentage, right? Why not sell units to Matt Mckeever and Jeff Ibo? I don't have large multifamily. That's all they're buying. I have the duplexes and the triplexes and the student rentals. I get a lot of that stuff. I get stuff that like the reason for that is the residential financing. I'm also not bullish on large multifamily right now. I think that and I don't want to throw shade, like they're doing a great thing. They're probably going to make a lot of money. They've been acquiring in the biggest bull market we've ever seen in 100 years, in a century in our market. And so they're buying at the right time. But they're buying stuff without cash flow. Like, so a lot of their buildings don't cash flow when they buy them. They're buying them at cap rates that there is no money right now. They're buying for future potential. And then they're doing all the work with that too, right? That's a business. And if I had partners, like if there's some running mate out there, if you're watching this right now and you're my running mate equal, and you, like what I had, remember when I was building Right Way, if you guys were watching 2-3 years ago, I had a running mate and he wasn't, I don't want to say he wasn't my equal. He just property management and operations were not his thing. And that was his role. If I had someone that could run operations smoothly, there was a time where I could acquire tons of properties under market value and I could bring capital in like nobody's business. It's not a problem for me to close a deal. There's 3 components to real estate: money, people, management, operations, and the deal. And I needed a running mate, but I can't find a good running mate who can do the property management, who can do the construction, who can run ops and do it efficiently. You need someone who's just like me, but poorer and enjoys that. Like once you get a certain level of wealth, you don't want to deal with the scumbag tenants. You don't want to fight with contractors who are going to knife you if they don't get paid in 2 hours and they're blowing up your phone because they only paid at 5 o'clock to go get drunk on a bender. That's construction. That's what you're dealing with, is those scum. I don't say scum. You're dealing with a different class of people, and there's just different things that go along with that. And it's a whole bunch of stress, and I don't want that. So would I ever buy Bulge multifamily? Maybe, if I could find a good running mate. I don't have a good running mate that wants to do all the work. All my friends just want to do the passive stuff. We all just want to, like, and it is active to find deals and it is active to raise capital, but I don't know, that part I enjoy a bit more, I think, than dealing with the operations. I don't enjoy operations, period. It's the reason I might even get rid of my crypto business. Part of it is because I'm moving and I know where to put them. But that little crypto business experiment, which I'll blow up again when I get my new house in September. But it's one of those things where you need someone to run point on the operations, and even just need someone to run point on hiring and firing and all of that. And I suck at firing people. It's like my biggest, like, I know my flaws. And one of them is I believe in people. Like, I like to see the opportunity that everyone has in them. Like, I look at someone, I'm like, this person just needs a little polish. I can see where they could really shine. And then they fail me because I'm too focused on how they could shine, and they don't, right? That's just people. People let you down. And I like to look at the best side of people. And so I'm not a good ops guy. Again, I believe the tenant when they tell me they're going to pay next month. I believe them when they say they're going to clean up the giant pile of crap in the backyard that the city's after us for, that they've created, these tenant issues. Or, I believe the contractor when he says on paper he's going to finish by Friday, and he never does. They never do. You have to ride them all the time, and I just don't want to do it. Anyway, so that's a rant. I don't want to go on anymore. I got to put the kids to bed here in a second here, but that's why. Do you see yourself leaving working with real estate for good? No, like I love real estate. I love buildings. I will always have some property, but I don't like holding it. If I don't have a good running mate, which I don't have right now, I need a good running mate. Don't have that. And so at this time, I would much rather invest and do options trading and do lending and invest in those things that I get great returns that I enjoy doing. Like, I have so much capital now that I can just live off the passive returns from my portfolio 10 times over. Like, I could lose half my portfolio and still be multiple times higher. Like, it's just dumb money at this point. What am I doing dealing with crap? I had contractor the other day threatening me, like, just decided to increase their price mid through the job, and then like just threatening me. Just crazy things. Like, some of these people are just mental. Like, you deal with the bottom half, the real working class, and there's a lot of mental illness as an example too that you deal with, and people who are irrational. At least in the stock market, when they're all irrational about AMC, I don't have to see their face. I don't have to worry. I can just short them. I can just go sell some calls and I'll get paid. You know what I mean? Like, it's all good. That's what I like, is a business that's the lifestyle suited. And real estate is not a good lifestyle business. If you can find a good property manager for a time, it's nice. Like, I've had good property managers for a while, and it's been good, where I've done nothing. I didn't go to the properties for a while, and it's good. It can be passive, sort of, but then you're still gonna deal with all the other crap. So I don't know. My thoughts are real estate's a great business to be in for flips. It's a great business to acquire. All of that, right? Like it's just the hold piece is not profitable right now at these valuations. I may look into the US and try to find a running mate there and blow some stuff up there and really build a nice sizable portfolio. I like real estate. I like the leverage piece. I like you don't get margin called on leverage. There are some advantages to real estate. It's just not in London, Ontario right now, given my current methodology. Would I still, if I was starting again, hell yeah, I'd be buying property in London, Ontario. If I had nothing today and I was starting again, I'd be buying in London, Ontario, and I'd be cranking out the cash flow, and I would build a portfolio that I could use to acquire more. I'm just not on chapter 1 anymore. I'm on chapter 20, and I got 100 more chapters to go, and I think that it's just a pivot. You know what I mean? Yeah, I answered your question before you even put it out there. For sure, I would still be doing real estate. It's one of the best ways to build wealth fast using leverage. Okay, so if I missed your question, which I missed a lot of questions this stream, I couldn't keep up. There's I think there's over 100 people that tuned in at one point to the stream. So thank you everyone for tuning in. I really appreciate it. One of the things, if I missed your question, copy your question now before the chat goes away and paste it in the comments after, and I'll respond to it publicly for everyone to see. So people talk about margin on dividends and are you still doing dividend margin strategy? Yes, I am. I have multiple portfolios, multiple layers of redundancy, that if one blows up, I'm still fire. I have multiple paths to fire. And real estate has been one of those paths. I want to reallocate some of that capital. I got millions of dollars trapped in my properties, and it's not producing near as much as it could. So I'd like to reallocate that capital. And one way it could have been to refinance the whole portfolio, but just too much work. I'd rather just sell it off, take the capital, and move on. You guys have watched my journey from 2016 on Matt Mckeever's channel to now. I've done sell everything, buy everything, sell everything, buy everything. You know, I go yo-yo on my portfolio all the time. When I was on those channels talking about selling my real estate portfolio, every time I sold a property, I bought 2 more. So I've never regretted a sale per se because it's always allowed me to do something else. And when I sell off these properties, I'm looking to sell off over the next year or whatever, slowly for tax purposes. I'll spread it out probably, and also for ease. It's a lot of work to prepare a property for sale and then sell it to get at least a fair market value. If I just sold them as is without cleaning them up at all, I wouldn't get what they're worth, right? The tenants need to clean up and everything needs to be presentable and good. And so a big piece of it is all the time and effort it would take to do that. And I got 3 kids and I got a million things on the go. I got no interest in. One thing you might notice too, guys, no interruptions tonight. Pro tip from an Instagram follower: airplane mode on my iPhone. We got no calls, no texts coming in. It's great. It's great. Yeah, if I missed your question, please throw it in the comments, and I'm definitely gonna try to respond to all those comments publicly. And if you want to save it for next week, just save it for next week, because like the sun coming up tomorrow, I'll be on every Wednesday around 7 p.m.-ish to 8 p.m.-ish Eastern Standard Time. I go live. You guys know it. 3.5 years now, never missed one. Christmas Eve, I went on. Boxing Day, I've been on vacation, whatever. My daughter was born the next day, I hadn't slept. I've done a stream, no matter what. So that's a guarantee. I'll answer one last question. I like this one, and I got this question a lot, and you repeated it twice, Derek, so I'll do it. What's your mining strategy after ETH 2.0? Can you mine Ravencoin and then convert it back to ETH? So yeah. So there's lots of things you can do, lots of strategies. You could mine something else. There are a bazillion different crypto tokens that are still proof of work that you can mine with those graphics cards. Also, Kudos in the fall is coming out with a platform where they're going to be selling compute jobs to miners. And so you can do for engineering firms and architecture firms, you can do the 3D rendering and the processing of large, complicated files using your graphics cards, not theirs. They can just farm it out, and you can make an exorbitant amount of money. We're talking more than Ethereum. So I think having graphics cards is a chip shortage right now. Having graphics cards is going to be valuable in the fall. I'll probably pivot. And again, they keep kicking and punting down the ETH 2.0 date where it switches to proof of stake. I don't know when that's going to be. Could be a year from now, potentially, right? But I think it'll be probably in the next 6 months. And by then I'll have mined a ton. And yeah, I think it's a good business to be in. If anyone's really seriously interested in buying my entire, all my machines, reach out to me on Instagram. We can have a chat. But you gotta be serious. You gotta have some cash. Yeah. So anyway, I'm moving in mid-July. This house is sold, and I'm going to live at the cottage. So you guys have to follow me when we live at the cottage on the lake. And then in September, my other house, the mansion, closes, the compound, the estate. And so I'm going to be homeless for a couple of months. And so I don't know where I'm going to put my, I'll probably just sell it, and then I'll buy more in the fall, in September. So that's probably what I'll do with my crypto experiment. Anyway, thank you all so much for watching. I really appreciate everyone tuning in tonight. And if I missed your question, please just put it in the comments or save it for next week, and I'll get to it next week, and we'll have another great chat. Thank you all so much for watching, everyone. The secret to unlocking a wealthier you, 3 levers. Spend less, earn more, and maximize the returns and the difference. In that order, and then once you've got the wealth, then you flip it, and the maximize returns is more important. Yes, I sold my house. We did very well on the sale of my house. I'm very happy about it. Didn't even hit the MLS. Did an off-market sale. So yeah, thank you everyone so much for watching. And I almost traded my house for the new house. That's how crazy this market's been. I almost laterally traded for twice the house. It cost me like, I think 7%, 5% more than my current house. Just crazy that I was able to trade houses. And I've traded houses now, to go on a tangent, since my first house in early 2012, which I bought for 200 grand. I've traded each house all along the way, all the way up to the mansion. And so really my mansion cost me 200 grand because I just traded tax-free all my houses up as I lived in them. And well, pretty much. Yeah, anyway, thank you all so much for watching, and we'll see you next week and on Instagram in the comments. Bye, everyone.